Okay, guys, welcome back to Libertas Trading and welcome to the event preview for Canadian jobs on Friday, the 7th of November at 2025. So let's just have a quick overview of the Canadian economy. So we'll go to the monetary policy report from last week just to see where the economy is going at the moment and where it's forecasted to go into the future. So in terms of economic activity, we had a negative GDP of minus 1.6, which was pretty dismal in Q2. Q3 is expected to be at 0.5, and then Q4 we've got 1% expected from the Bank of Canada. So yeah, really nothing special in terms of growth. Consumer spending's been holding in quite strong, which is, the Canadian economy has been surprisingly resilient considering what's happened to it with the tariff stuff with America. Got housing activity, which is moving up a little bit the last few months. As we said, weak growth expected in the second half of 2025. Exports to the US are down $24.6 billion so far, which is pretty substantial, to be fair. For any country, that's a substantial number. We've got labour market weakness. I think we're at 4-year highs on the unemployment rate, so the labour market's not looking great either. And then again, employment growth, which is weakening and is expected to weaken a little bit more. They have actually said as well that by the end of 2025, it is estimated that fewer than 5,000 jobs will be needed to added each month to sustain the unemployment rate or the employment rate. So this is where immigration's come down a lot in Canada the last few years. So, we're needing to print less jobs, similar to America, really, needing to print less jobs to keep the job market ticking over. And then we've got wage growth, which is coming down as well quite firmly. Now inflation's been a bit sticky, especially this year. We've seen that rise up back above the 2% target, but that is forecasted to come back down. And then we've got, hitting by January 2026, getting back below the target range. And then finally we've got, where are we? Here we go. Oil prices, which haven't exactly been supportive for the Canadian economy either. Now, in terms of rate pricing, we've only got 16 basis points of cuts priced in for the rest of this year and next year. I think we've had 275 basis points of cuts. So the Bank of Canada have basically finished their cutting cycle. I mean, if we did get some horrendous growth prints and horrendous labour prints and inflation starts coming down a little bit, of course, they might cut a little bit more. But at the moment, with the sticky inflation, with weak growth and weak labour where it is, but still being quite resilient, that's basically it in terms of the rate cutting cycle. So due to this, I don't see any massive changes in the money markets for rate pricing. So I will be sticking to a short-term play. Now, that's one reason for it. But the other reason I'll be sticking to a scalp on this one is due to past reactions, which we'll go through in a second. So just looking at what numbers we're looking for a trade, you can head over to the trade scenario sheet for this week. So for a dovish reaction, I'd be looking at minus 50k or lower, which is 25k below the minimum and should be enough for a scalp. And then for a hawkish reaction, nice and easy here, 25, 25, 25, 50, sorry, 25, 50, 25, 50. So for a hawkish reaction, I'll be looking at 50k or higher, which is above the max and should be enough for a scalp. So for anyone who hasn't traded the jobs data for Canada before, the employment change is made up of full-time jobs plus part-time jobs. So of course, for a strong economy, you want full-time jobs to be higher and part-time jobs to be, less of this. So for a dovish reaction, I would want the majority of the minus 50k on the employment change to be from full-time jobs. And then again, of course, I'd want the majority of the 50k in the employment change to be from full-time jobs. So, if this prints at say 40k, for example, but full-time jobs is 60k, amazing. That's the important thing. We're looking at this full-time jobs number. If this points at like minus 50k, but the full-time jobs is positive, well, that's not good for the economy and that's not worth a trade. So that will be a mixed print. We'll go through some past examples just to sort of get the hang of how markets react to certain prints in a second. So for the unemployment rate, I'll be looking at 7.2% or higher, which would be the highest since July of 2021. And then for hawkish reaction, I'd be looking at 7% or lower, which would be a 3-month low and moving in the right direction, which could be a peak in the unemployment rate, which I'm sure the Bank of Canada would appreciate. And then for average hourly earnings, quite simply, I'll be looking at 3.5% or lower for a dovish reaction and then 3.7% or higher for a hawkish reaction. And of course, for a dovish reaction, we're expecting CAD lower, and for a hawkish reaction, we're expecting CAD higher. Now, these numbers may look a little bit, a little bit far-fetched to print this much lower below the minimum, but this is a very, very it's a very, very choppy data set, and it's very volatile. So we'll just quickly look at some past reactions now. So this is the consensus deviation here, and then the minimal max deviation here. So we can see last month we printed 55k above the consensus and 35k above the max. The month before we printed minus 76k below the consensus and minus 31k below the minimum. Again, 55k below the consensus, 31k below the minimum, 83k above the consensus and 58k above the maximum. So just in the last 4 months alone, we've had some massive misses and some massive beats. So I think that's one of the reasons we don't get much follow through on the Canadian jobs data, because it can be such a volatile data set. And you probably want to look at like a 3-month annualized print. But in terms of just scalping from this, I'm just looking at normally, 25k below the min and 25k above the max. I think is pretty good. And in an ideal scenario, we need all of these to line up. So we need, especially the unemployment rate and full-time jobs, we need to be lining up together. So let's just have a look at some past reactions just to see how markets have reacted in the past, and the reason that I'm not going for a medium-term trade. So this is September data from October 2024, and you can see here the employment change came in about 20k above consensus and just below the minimum. But look at that full-time employment, 112k jobs from full-time employment, which is an amazing number. And also the unemployment rate, which came in at 6.5, which was below the minimum and 0.2% below the consensus. We saw a really nice move here lower. Like, this is almost a perfect print with the unemployment rate and the full-time jobs coming in so high. Of course, we did have average hourly wages, which came in a bit lower, but that's not the end of the world. And we see here that price moved down nice, but we did peak after about 10 or 11 minutes. And then just looking at the 5-second chart, again, we peaked after about 4 minutes there. We sort of meandered around this level for a bit, but actually looking now on the 5-second chart, the low was after about 3 minutes. And you can see here, this is very common. You'll see this a lot with Canadian jobs data, especially not on NFP week. It's always worth waiting for a little pullback. So I know you could have entered here on 5 seconds, but actually with the volatility, you're probably getting filled down here somewhere. So just wait in between sort of 10 and 15 seconds for a fill, in my opinion, and in my experience, always pays off. So that's the data for October. So just again, looking at the EuroCAD for Feb, we had pretty good employment change, which came in basically on the max. Unemployment rate again came in 0.2% lower than consensus and 0.1% lower than the minimum. We had 35k of jobs coming from full-time, which is only a small percentage of that employment change, but it is actually above the consensus. So we had more full-time jobs created than the consensus of complete jobs created. So this was quite a nice print. And again, here we basically peaked after about 4 minutes. And then we just sort of meandered around this level and then ended up pushing a little bit higher. So just quickly looking at the 5-second chart. The 5-second chart, you've got to sort of ignore this this price action here. So basically this was NFP week. So we do tend to see these like crazy spikes in the first 5-10 seconds. We won't speak about that now. We'll talk about that next month if we get NFP. But, this isn't an NFP month, so we haven't got to worry about this. But again, it would have been worth entering after about 10-15 seconds, and then look, price bottomed here after about 4 minutes. So again, another short-term trade and another trade where it was worth waiting for an entry. So head into August of 2025, we had a bit of a mixed print here. So we had wages come in higher. The employment change printed well below that minimum, at 30k below the minimum, and the full-time employment was minus 51k, which was absolutely massive. But we did have the unemployment rate come in nicer at 6.9%. So that could have been a reason that we saw a bit of a dreadful reaction here. To be fair, we completely reversed within half an hour. But at the same time, as with the previous data, we peaked at around 3 or 4 minutes, and that's my sort of target time for today. So just looking at the 5-second chart on this one. So yeah, you probably wouldn't have done too well entering after 10 or 15 seconds on this one. It would have been better to wait for a longer term pullback. But again, that unemployment rate would have kept me out of this trade. You really want employment change and the unemployment rate to come in together. But this is just an example to show you what happens when we get these mixed prints here. So this was a print from September. Again, not an absolutely perfect print by any stretch of the imagination, but the employment change came in really soft, minus 65k, which was massive. We had the unemployment rate, which came in at 7.1, which was 0.1 below consensus, or above consensus, sorry. And then we had the full-time employment change, which was at minus 6k. Now, of course, that's only a small portion of this, but it's still printing negative jobs, and it's still printing 16k below the consensus for employment change. So even though this didn't print the majority of the jobs, it still wasn't the worst print of all time. But this was another mixed print. So just to show you the reaction on this one, again, not the best print, but we still had a fairly nice move from it. So this random little spike here was just due to, because we're at NFP week. Again, it would have been worthwhile waiting for a 10 to 15 second pullback, and then you could have made some nice money scalping between like the 3 or 4 minute mark. This is again where we've generally peaked in the past. So just looking at last month's print. So at the moment, I've sort of been giving you, mixed examples, or not exactly 5-star trades where all the stars have aligned. So I just wanted to show you this chart from last month, and this is the main reason why I'm sticking to short-term plays today. So just look at this data. We had wages coming in flat. The employment change was 60.4k, which is 55k above consensus, and it was 35k above the max. We had the unemployment rate coming in at 7.1%, which was below the consensus. And then we had full-time jobs at 106,000, which is absolutely massive. And it really made up for the 2 months prior, which were dreadful. So based on this, like, you would have gone big and you would have held. But again, look at the reaction. We had like a 4-minute peak. So just head into the short-term chart. Again, we can see a massive move lower in price. We can see price retrace for about 10 to 15 seconds for it to then move lower. Again, remember that you could have entered here and not been far off waiting. But if you enter within the first few seconds, you're not getting a fill here. You're probably getting filled down here somewhere. So it is normally worthwhile waiting 10 or 15 seconds just for spreads to calm down a little bit. And then again, we did move lower. It was a nice trade. I made some money off this one. But price again bottomed out after about 3 or 4 minutes. So, just based on this trade alone from last month, this is the reason why I'm sticking to short-term plays. We couldn't have really asked for a better print than this, and look at the reaction. So that's the reason I'm sticking to short-term plays. Now on the subject of short-term plays, so I'll choose my pair depending on how Euro US dollar is trading at the time. So I'm only sticking with Euro CAD and US dollar CAD. So based on past results, as we spoke about, I'll be in and out nice and fast. Prices tends to peak after about 3 or 4 minutes. So if I haven't hit my target levels by then, I'll either close the trade or reduce my position size and hopefully bank some profits. So in the past, it's almost always paid to wait 10 to 15 seconds before entering, which we've spoken about. I also have smaller targets when it's not NFP week, as we seem to get nicer entries and there's a lot less vol in the market. So my entry levels, or my target levels, sorry, will be 18 pips on the Euro CAD and then 15 pips on the dollar CAD. Now, again, I won't be looking at medium-term plays, but for anyone who is just looking at medium-term plays, it's been pretty hard. We've had a pretty messy week this week with all the stuff that's going on with the risk sentiment, and we've had some real mixed reactions to data as well, especially with the dollar. So based on that, I've used a lot of technicals and a lot of momentum in my sort of scenarios for potential medium-term trades. So for dollar CAD longs, on a dovish reaction, I'll be looking at that because the dollar struggled a little during yesterday's session, but it's stronger on the day today. The US economy is holding up a lot better than the Canadian. Still seeing some momentum from a more hawkish Fed last week, and technically we have some tough resistance at the 140, 150 level. But if we do crack that, the pair could keep moving a lot higher. So quickly looking at the dollar CAD chart. So we've got some resistance, turn support, term resistance here. So if we do get a really, really bad print, going long dollar CAD could be quite nice. We're sort of playing with momentum. Since the Fed decision, this pair's been moving a lot higher. So if we can break above this 41.50 level, we could see some solid upside. Also for a dovish reaction, could be nice looking at CAD yen shorts. So the yen's been pretty strong this week on the back of some jawboning from the usual suspects about yen intervention. This coupled with dollar yen finding some solid resistance at 155 should be enough to put off some Japanese yen sellers for the moment. We've had Takaichi, who's obviously been more dovish for the yen, but it would be easy to argue that that's fully priced in by now, and her comments haven't been causing too much movement. And we're also at huge resistance for the pair. So just looking at CAD yen shorts, you can see here on the daily chart, we found some real solid resistance, so that 110 level, and we've came down from that. But just zooming out to the weekly chart, you'll see just how big that resistance level is. So if you just give me a second here. Here we go. So going back to 2022, we've had 1, 2, 3, 4, 5, 6 or 7 solid touches of that 110 level. So, just looking at a longer term time frame, it wouldn't be too surprising to see the Canadian dollar, Japanese yen move down from this level, as it has done in the past quite substantially. So for a hawkish reaction, I mean, it's pretty hard finding a case to buy the Canadian dollar at the moment, but for anyone who is looking to buy the Canadian dollar, New Zealand dollar CAD shorts could be quite nice. It's quite a momentum play because the Kiwi's the weakest on the session again, and I think it's the weakest on the week. Risk off sentiment will weigh on the pair if it continues into the American session as well. So just looking at the chart there, again, this is a bit of a momentum play. As you can see, the Kiwi's getting smashed again today, so it could be quite nice looking for a bit more downside, maybe targeting the 78.50 level where we peaked down in April. So that could be a bit of a nice risk on play, and then or risk off play, sorry. And then for anyone looking for some risk on, CAD Swiss franc longs could be quite nice. We're at quite a nice support level, and Swiss inflation coming in soft earlier on in the week on Monday may still lend some support. So again, just looking at some CAD franc longs if we get some risk on sentiment going into the American session. So here's the Canadian dollar Swiss franc on the daily chart, and we've had this level at 57 cents, which is, it's been quite nice. Support, turn resistance, turn support, and we found a nice bounce from there. So maybe buying from here and targeting 57.60, maybe targeting this 57.85 level could be quite nice. So again, not looking at anything medium term on the back of this, but these are my potential plays. If we get for a medium term play, you'd really want something like minus 80k or 80k on the and we'd really want sort of like 7.3 or 6.9 on the unemployment rate to really get that medium term play. Any questions, feel free to message me through Substack. For anyone who hasn't signed up yet, I've just started a Substack, and we're doing free subscriptions for the month of November. So sign up for the free service and you'll be getting a full, basically getting the full paid service for free for the month of November. There's no card details needed. I don't like all those sort of sales gimmicks where if you forget to cancel, you're stuck on a subscription. So yeah, it's free to sign up, and any questions, message me on there or message me through Discord. And yeah, good luck.